Good afternoon, options traders. Well, I couldn't help but post this video, and I know I've talked about it before, but it certainly bears repeating. And the reason is that earlier in the week, I believe it was on Monday, I was watching CNBC and they were interviewing a woman from a very large capital management firm. Not going to mention any names, but she supposedly has 20 years of experience, and this interviewer was kind of challenging her on her recent sale of Apple shares. And so she gave her explanations, and then at the end, she gave this little kind of this smile and this final, like a coup de grace blow here of saying, well, always remember, you can't go broke taking profits. And that was kind of her final justification for saying it's never a bad decision. Well, it's probably the worst expression on Wall Street because you absolutely can go broke taking profits. It is absolutely mathematically incorrect to say that it can't happen. And the reason has to do with the fact that you're not letting your winners outpace the amount of risk that you're taking. So for anyone who might be new out there and hearing that you can't go broke taking profits, it's absolutely false, and let me show you why. Here's an Excel spreadsheet that I built just to hopefully make the concepts a little clearer without getting too much into the math. So what I've done here is we're going to assume that when the trader wins, that person can make 20%, but when they lose, they're only going to lose 18%. Part of the reason that I did this is that you'll hear this a lot from traders, and they'll say, well, you don't understand that I limit my losses. I use stop orders or what have you, but they have some way of thinking that their losers are going to be a certain amount and their gainers will be bigger. All right, so let's give them that. In the next column, we have the trades. So each row is simply a trade, whether this is multiple times in a day, weeks, doesn't matter, but each one is an independent trade. Next column, we have a random coin flip from the computer that's going to determine whether they win or lose. So if it comes up a 1, that's heads, in which case they win 20%. If it comes up a 0, then that's tails, in which case they lose 18%. So I'm going to use a coin flip here, 50-50, because remember what we're trying to challenge here is the statement about you can't go broke taking profits. We can't account for stock picking skills, which would be questionable in itself, but let's at least just eliminate that aspect of it. And let's say that it's just about taking profits when they show. So we're going to use a 50-50 chance for wins and losses. And really, in the real world, that's about what it's going to work out to be. In the next column, we're going to start everybody off with $100. And so here we go. Trade number 1 comes up heads. We win 20%. So we now have $120 in the account. Trade number 2 comes up heads. Win another 20%, we're up to 144. And so on. Then we're up to almost 173. Trade number 4, we lose 18%. We're down to about 142. And so on. So the idea is that at some point, the trader might say, hey, look at this. I've got profits of about 142. Let me take it. After all, you can't go broke taking a profit. But here's the problem, is that take a look at what happens in the long run. And that's what this graph is over here. This is after years of trading, and we end up below this red line. This red line is our $100 starting point. And we end up at 0 if we sit there long enough. Now, there's a couple of reasons that this is happening. Let me explain. The first one is that when you win, you're multiplying your money by 1.2, and when you lose, you're multiplying it by 0.82, which is just saying 1 minus 18%. Because after all, if you lose 18%, that's the same thing as saying you kept 82%. So because these gains and losses will compound, we can multiply these together. 1.2 times 0.82 comes up to 0.984. What does that mean? It means that on average, you are retaining 98.4% or losing about 1.6% on your money, even though you've got what appears to be a very big edge. And that's why we are losing out here in the long run. Now, as a second problem, completely unrelated, but when traders make this statement that you can't go broke taking profits, they're assuming that they're going to take that profit and redeploy it in a different investment that will now make money. Well, who's to say that the one that they left isn't going to continue going up and the one that they just got into actually continues down? So it's more of a psychological crutch. It feels right to lock in that gain, but the overall problem is that the gainers are not big enough to offset the losers. In other words, the amount of rewards that you're taking here are simply not big enough relative to the risk. That is the key. So what if the trader, let's say, could take 22%? Let's change this to 22%. Now look what happens. Now in this case, we ended up on the profitable side. We're well above our $100 starting point, but that won't always be true. So here we did the same thing, but now we're below. Do it again, we're actually below. So as before, are there times that we could be profitable? Sure. But if you sit there long enough, it won't work out that way. So again, losers, a tiny bit of a gain, fairly good gains up here, big losses down here. But at least we have a fighting chance. There are some times when we can end up on the profitable side even after a fairly long run. But that's because we're letting the gainers run relative to the risks that we're taking. But watch what happens if we go to maybe 25%. Now we're going to end up on the positive side. We're above the red line, barely above the red line. In almost all cases, we are at least above the red line. Not guaranteed, but looking pretty good. But watch what happens if we go to 30%. Now we'll never fall below the red line. Just isn't going to happen. And so this is what it ultimately shows, is that the only way you can truly lock in gains or end up with long-term profits is to let the amount of your winners be big enough to account for the risks that you're taking. It has everything to do with this relationship, and it has nothing to do with taking profits on the false belief that you can't go broke. So what can you do? This is why I tell traders to hedge, roll, and morph. When you learn these techniques, you can allow profits to run, but you can also lock in gains. And letting your profits run is the key, and options are the best way to do that. So for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.